am your host, Christopher Calandra, and on today's episode, I wanted to provide you with an overview of the investment process we use at Elliott Wealth Management Services. So I have been a financial advisor for over 25 years, and over the course of the 25 years, a lot has changed. First off, I've been in several business models over the years. Secondly, the industry has evolved, especially when it comes to regulations. Regulations are much more intensive now than they've ever been, and they seem to get more stringent all the time. Another driver changing our industry is technology. I know this is the same for many industries, but the technology that we're using today and what is coming in the next few years is having a dramatic effect on how clients want to deal with their financial professionals. Also, it's worth noting that the practice here at Elliott Wealth Management Services has had a successful several years. We have done a very good job, and we've been blessed with being able to attract and retain excellent clients. And we get to deal with people that appreciate our services and people that we enjoy doing business with. We're very blessed when it comes to that. What's happened over the last couple of years, in part because of regulations, in part because of technology, and also in part because of the growth that we've experienced in terms of the number of clients as well as the number of dollars that we manage for our larger client base, we have developed a very solid investment process that provides customization as well as personalization. And we call it the core allocation process, or CAP. And I wanted to talk to you a little bit about it, give you a flavor for what we're doing, how we do it, and why we do it. For the purposes of this podcast, I'm not going to go into a tremendous amount of the detail that goes into this, but I did want to provide an overview. So with CAP, two key ingredients. Number one, we look at primary factors. So we have a dynamic selection process that is rules-based that helps us determine and identify what we want to have in client portfolios. And then we look at establishing and constructing risk-adjusted portfolios. So risk-adjusted portfolios, that's a little bit of the jargon you get in our industry. But let me give you a good, classic, simple example of risk-adjusted portfolios. If I were to ask most people most of the time and ask them the following: listen, I have investment A that returns 10%, and I have investment B that also returns 10%. Which would you want to have? Again, most people most of the time are going to say, Chris, it doesn't matter. Both of them return 10%. It doesn't matter. But the better answer is, and the answer that we seek here at Elliott Wealth Management Services when managing money and constructing portfolios, is we want to select either A or B based on which investment took less risk to achieve that 10% rate of return. And that, again, is a good example of risk-adjusted portfolios. It's not just the return, it's how much risk you're taking to achieve a rate of return and how much downside risk is included in the portfolio. And then the last of the primary factors is portfolio flexibility. I'm going to use this term, flexible, as well as other related synonyms, quite a bit in this podcast, but we have a lot of flexibility on the portfolio front. So the primary factors: dynamic selection process, it's rules-based, we're constructing risk-adjusted portfolios, and we want to maintain lots of portfolio flexibility. The second key element of this is the research model. It has 4 different parts. It's behavioral, which is looking at technical parts of the markets. That includes sentiment. In a very simple illustration, that's what's hot versus what's not. We look at fundamental analysis. We track global themes. In other words, where the U.S. and or the global economy is in the economic landscape. And then lastly, quality. We want to select investment vehicles that are quality. Oftentimes that's related to liquidity, who is, in the case of mutual funds and exchange traded funds, that we're dealing with quality money managers and highly thought of companies. So under the research model, we're looking at behavioral, fundamental, global themes, and high quality. And so that's the CAP, core allocation process. So let's talk a little bit about what this enables us to do and why it is so beneficial to our clients as well as us here at Elliott Wealth Management Services. So to begin with, I wanted to mention that we are independent. We're a small, independent investment advisory financial planning firm. When it comes to these portfolios, we are ultimately making the decision on what goes in the portfolios, but we have some excellent relationships with a few outside consultants, and some of them are amongst the biggest investment companies in the world, and that enables us to get their opinions and tap into their research database, their metrics, and so they bring a lot of outside perspective and depth in helping us work on CAP, the core allocation process. So that's the first thing. Second thing is that remember that these portfolios are risk-based. So when we're meeting with a client and we're outlining what their goals and objectives are and figuring out if they're on track and how we might be able to achieve their financial goals and objectives, we are going to use risk-based allocation models. We'll work with the client to determine how much risk is appropriate for them, and we're going to use a portfolio that's going to be appropriate for them based on their risk. It's worth noting that that is not a static thing. People's risk level changes for any number of reasons. A good example is that lots of people, as they get older, will tend to become less risky and want to be more conservative. And so the flexibility we have in these portfolios is that as clients become older and perhaps they want to become more conservative, we can easily, flexibly make changes to the portfolio to either increase or decrease the level of risk in the portfolio. This flexibility allows us to move out of the market and into the market and change positions quickly, and that is advantageous for us in trying to make good decisions for clients, and our clients really find this very appealing. We are not rapid traders. We are not day traders. We're not likely to take big bets in any one position or any one sector. We rely on a tremendous amount of diversification and construct these portfolios using a wide array of asset classes, company size, all different shapes and sizes. But that flexibility is really powerful. The next thing I wanted to mention is that this is an inclusive process. CAP is very inclusive. And what I mean by that is we set up portfolios that are risk-based, as I mentioned earlier. But let's say we have 100 clients, just as an example, in one of our portfolios. Let's say it's the growth portfolio. When we make updates to that growth portfolio, all of our clients that are in the growth portfolio get that update, and they get that update at the same time. So whether it's our biggest client in the growth portfolio or our smallest client in that growth portfolio, everybody gets the update at the same time. We're fond of saying that nobody gets left behind. And that is something that is really attractive to clients because that constant updating where we're making changes to the portfolio, which typically we're going to make 3 to 6 updates / changes to a given portfolio in a year. So I'm recording this towards the end of February. We've already made 2 updates to all of our portfolios this year. I don't know where we'll end up the year, but we'll probably end up somewhere in the 3 to 6 changes to the portfolio over the course of the year. And our hope and expectation is that we'll make enough good updates and changes to the portfolio to help us carry out our goal of creating good, worthwhile, risk-adjusted portfolios. In Season 2, Episode 5, I did an episode that was strictly focused on rebalancing. I would draw your attention to that episode. It's very good in its own right, but it also ties into what I'm speaking about now, because one of the common types of updates that we do is rebalancing. So one of the examples I gave in Episode 5 was if you have a client that has, say, again, very simple example, has 50% in stocks and 50% in bonds. What rebalancing does is pays attention to that 50-50. And over the course of time, it's likely that the 50-50 is going to change. So let's just, for argument's sake, say that stocks end up getting to 54% and bonds at 46%, which means now that the portfolio is more risky than it was originally when it was 50-50. What we will do in the process of rebalancing is we will go back to the initial 50-50 split, thus reducing the stocks and increasing the bonds a little bit. It's a good risk mitigation tool. It's not perfect. It's not the end all to be all, but it's something that we have increasingly focused on, is doing rebalancing as part of our updating process within the CAP process. The next thing I wanted to mention is that we primarily, and I emphasize primarily, we primarily work with clients on a fee-based, no transaction fee platform, whereby we charge client a percentage of the assets that we manage, and in exchange for that charge, they get all of our customer service, goal setting, working with them across the spectrum of the financial planning process. But when we make changes to the portfolio, whether we're making changes, the client requests changes, we have to sell to accommodate a client taking money out, for whatever reason, the client is not paying any transaction fees, no commissions, no sales charges, no early redemption fees. And I'll come back to that flexibility word again. Gives us tremendous flexibility and the client tremendous flexibility. In other words, we could take a position in a particular investment today, and although this is unlikely, we could conceivably sell it the next day, and it's an investment decision that we could make. And the key thing for the client, as well as for us, is that there's no cost consideration in that. The client doesn't have to say, oh, I'm glad you're making changes to the portfolio. I appreciate you being on top of it. Oh, by the way, what's it going to cost me? No. There's no transaction fees. The client is paying a fixed percentage on the assets that we're managing. So when we make changes, the client and us does not need to pay terribly close attention to the cost of those changes because there aren't any. And we love this system, we love this process, we love this platform, and we find that clients are increasingly attracted to it as well. And it's been a key ingredient in our success over the last few years. The final thing I will say as we begin to wrap up is that on this platform, we are fiduciaries. That's again another one of those jargon terms that basically means that we're obligated by regulation to do the right thing for the client, to put the needs of the client first. Now, we do this anyway. I would take a lot of pride in saying that I have adhered to that for 25 years of my career, even though I may not have always been technically a fiduciary. But the fiduciary standard means that we are going to act in the best interest of the client, put their interest first. And this platform makes it easier and quite clear on how we can do that, and the transparency of the fees is very helpful. So that is our investment process here at Elliott Wealth Management Services. I'm glad I had a chance to talk a little bit about the core allocation process, or CAP. You can get more information about me and the rest of the team at Elliott Wealth Management by going to our website, which is www.elliottwealth.com. Elliott has 2 L's and 2 T's. At the website, you can do a few things that I would love for you to consider. Number 1, you could subscribe to the podcast. Number 2, you could sign up for our mailing list. And third, and most important, is request a complimentary initial consultation where we could review where you are, where you want to go, what's important to you, and perhaps explore some ways that we might be able to be of some help. With that, I will be back with you on an upcoming episode of the Simply Financial Podcast next week.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.